I've been paying distributions 12 to 13% to my investors every quarter for 4 years, and I've never been to the property. So,
Joel, I invested in one of your deals, and you've never been to the property?
What is up, guys? Welcome to episode 002 of How to Invest in Commercial Real Estate. My name is Braden, and I'm joined by my co-hosts, Brian and Joel. What's up, guys?
What is going on?
Braden.
Thanks for your time. Thanks for coming back. Today is episode 2, and we're going to walk through a typical real estate deal. So, we've done a couple $100 million of transaction volume so far, and we're just going to walk through what one of our deals looks like, from start to how we found it to ending. We've closed. What do we do now? Let's kick it off. What do our deals look like? Where do we start? Where are we getting them?
Yeah, so let's dive into the one you guys purchased, a little over a year ago in Broken Arrow?
Yeah, okay.
Red Bud?
Red Bud. So that is a good deal. That was the first deal we did under the Criterion flag. So we like that one. It's in Broken Arrow, Oklahoma, and it is a 20,000 square foot retail shopping center with about a dozen different businesses in there in front of a Walmart that you can see up here. So
so how did you guys find that deal?
Yeah, so a lot of our deals are sourced through real estate brokers. So real estate brokers obviously only get paid when they're selling and closing deals. So they're building up lists of buyers and real estate investors that as soon as they get a listing or a deal, they want to send it out to as many potential buyers as possible. And I was fortunate enough to be on this guy's list. It was a real estate broker down in Dallas, so it wasn't even in my market, even though he was selling the property in our market.
Was it just a blast email he sent out to
it was
hundreds of people, his entire list, I guess?
His entire list. It may have been thousands of people. I mean, probably hundreds. Yeah. And that's a common thing to do with real estate brokers. They get a listing, and maybe even before it's done, they're sending it out to all the prospective buyers that they can, because they want to get that sold as fast as possible, because that's when they're getting paid. That's their job. It's
slightly different than residential, in that in residential they put it up on a multi-list service where everyone can see it. Commercial real estate's a little more... they want to protect a little bit more, so you have to get on their list. They don't just there's a few sites that most listings are posted, but some brokers want to get the full commission. They don't want to co-broke it, so they want to send it to their list first.
Right, and they're gonna have a lot of private information that they don't want to just publish everywhere. You'll probably have to sign a light confidentiality agreement, which just says you're not going to blast all the information about the property out. But it was really just an email, and it was over a period of time, and we just watched it and got a few emails, and we underwrote the deal, went in, and when you first get a deal like this, you do quick and dirty is kind of what I call it, and you just go through and analyze it, see if there's tenants you like, see if it's an area you like, see if it's good income, and you can kind of throw out a lot of bad deals just by your quick and dirty.
So what kind of attracted you to this particular deal that said, hey, I'm going to go through the process of doing a model, underwriting it? Are there some keys that you look for?
Yeah, I think so. Charlie is super excited about that, obviously. We are located in Tulsa, Oklahoma, and this is in Broken Arrow, so it's in the Tulsa market, so we're super comfortable with it. It's in a great built-out part of town with existing retail and really good traffic counts for our market, which is probably 40, 50,000 cars a day right at that intersection, people coming in and shopping or driving by.
It's 6 lanes. For those not familiar with Tulsa, it's 71st is not a highway, but a main street cutting right through the middle of Tulsa, and it's 6 lanes all the way through. So
yeah, connecting Tulsa and Broken Arrow. It's a busy thoroughfare, and it was located right in front of a Walmart, and their traditional development style where they have the out parcels of fast food or quick service retail or your traditional retailers that follow Walmarts. I mean, there's a dozen retailers that will be next to every Walmart ever. So you can kind of rely on that and those tenants. The biggest problem that I didn't like and that kind of kept me away from center is that there was a GameStop in it. And GameStop just really wasn't doing well at that time. And, it didn't make us excited about it, but the rest of the deal was good enough to where we still watched it. We still monitored it, underwrote it. They had some long-term leases in there.
We actually underwrote it, assuming GameStop might leave, right?
Yeah.
And we wanted to see if we were still able to make a good return on it without them.
Yeah, and the other hesitation I would say in the beginning is that there was probably a third of the leases were going to expire within the first year to 18 months of our ownership. So there was a little bit of risk there. If we didn't get some of those lease renewals, we may have a vacancy, and we would have to go find a new tenant. So there was caution, but at the same time, that's why you watch it. So we probably found out about the deal in April of 2019, and we ended up closing on it in November. We probably put our first offer in, maybe September-ish.
Yeah, I think that's right.
And
well, there's a lot of retail in that area, so we knew even if some of these leases didn't get renewed or whatever, we knew we could. And we had compared the other lease rates in the area, and they were all either about the same or even higher. So we knew we could get some new leases in there.
What I like about these types of centers is there are a lot of smaller footprints. And so, if you have a vacancy, it's 1,200 square feet. It's maybe, 5% of the center versus getting some bigger box stuff that struggled as of late. And if you lose it, it's a huge hit to the cash flow, where this, you have maybe a small hit to the cash flow, and you typically can find more users for that size.
Yeah, and especially in a full Walmart parking lot with restaurants in the center and people coming to eat, it's already full. It's not relying on that. It's got good walkability. So those should be really easy to backfill. Yeah.
Are those the same things you look at, Joel? I mean, some of these things that we talked about, high traffic count, a big shadow anchor tenant.
Yeah, for retail, it's different than multifamily. The location matters way more for retail, because it's not, people will live in a lot of places, but people aren't going to open up a business if they don't feel like they're going to be successful. So this is very well located right in front of a supercenter and right on a 6-lane residential street with high traffic counts. That's a real big plus. I typically, it sounds weird, I like the look of a center. It just looks nice and relatively new.
Well, would I want to spend my money here?
Yeah.
You think
is this
from
somewhere
the consumer?
you would go? Another thing I look at is market rents, and can I easily replace this if I lose a tenant? I'll give an example of like a Starbucks. Starbucks is an awesome tenant, and people say, "Oh, I'd have to have a Starbucks." The problem is that you're buying that at a really low return rate, and the rent may be $40, $45, $50. So
per square foot
per square foot per year. And so if they bail, or even just at the end of their lease, they don't renew, maybe they're going to go to a newer location. I mean, you may backfill that at $20 or $25 a foot.
Half the rent.
Yeah, and so not only did you buy it at a skinny return, your return's going to get wiped out if you're not going to be able to fill it with a Starbucks-like company. Where we've just had success in these older, they call them second generation, so it's not the brand new Chipotle type of tenant, Starbucks. It's kind of a second generation where you've got some decent credit or mom and pop tenants, but your rent per square foot is maybe $12, $15 a foot, where newer stuff a mile down the road is $25 a foot. And so if you lose a tenant, you have a competitive advantage to be able to lease it back up.
Yeah, and that's a really good point that you can kind of tie back into Redbud when you're looking at the price per foot that you have to rent that for to get that return. A big thing you think about is how much you want to buy that per foot on the purchase. Because if you're building or if you're buying a building at $100 a square foot versus $300 or $400 per square foot, the income you're going to need to make the same return is a third.
Mm-hmm.
So it's theoretically a lot safer because you're not taking as much risk saying, hey, I'm buying a premium tenant at a super expensive rate with a super high price per square foot on the building, and if they leave, I'm going to have to go get that again. Versus, a smaller, cheaper mom and pop space, it's easier to lease that because it's cheaper and the barrier to entry is a lot lower.
Yeah, so then we've kind of talked about why you like it. You're getting ready to make an offer. Tell us how you go about determining a purchase price. Obviously, some of it is conditioned on what the seller's asking, but I'm sure because you were looking at it, the seller was kind of in the market range. How do you decide on the number?
Yeah, so obviously, you need to be underwriting deals in the market and make sure you're not overpaying for that market. So Brian and I are looking at, a dozen deals a week, if not more. It could easily be double that some weeks, and you're going to know, oh, this is a good deal for this market, or this is a bad deal for this market. Most of the time by the cap rate or the income or the price per foot, just a few key indicators so you can say, okay, that's normal. Next thing you want to do is just take in a couple assumptions. You want to kind of plug in what debt you think you're going to be able to get, because that's the majority of the capital stack. A lot of the times we're getting 75 to 85% of the capital on a deal from the lender. So that can be a big variable just, in market conditions on debt that can swing fast. And build in a little buffer for yourself. And then you want to go in and plug in what returns you need to get for yourself and your investors, and just reverse engineer it. If I can get a 17% return and I can get debt for, a 4% interest rate on this deal, then that's going to make me happy. And I need this price in order to do those things. And, maybe that's $4 million, to get your 17% return. But if you were paying 4.2, you're only getting 15% return. Right. So, it's a couple points. You wanted 17%, but you may end up taking 15%. So that's kind of how we do it, is we reverse engineer based on what returns we need.
Yeah. So for those that aren't too familiar, you're buying at a cap rate. What was the cap rate you bought this deal at?
8.25.
About 8.25.
8.2. Yeah.
Okay. And so you're buying at 8.25. That means if you paid all cash, it's going to yield you, or should in theory yield you, 8% return, 8.25% return on your money.
Yeah.
Okay. So then, but we want to get to 15 or 17 or higher. So
how do you do that?
Yeah.
How do you take this, because a cap rate is a strictly unlevered return. If you bought it in cash, if you bought that $5 million property in cash and you bought it on an 8% cap rate, you're making 8% on that $5 million a year.
Yeah. So the key, and this is why real estate is such a great investment, is the leverage that you can get on it. And so when you say, hey, the bank will loan you 80% of the purchase price, but you're not paying 8% on that money, even though you're earning 8% on the deal, you're paying, what was the rate on this deal?
4.01%.
Okay, so 4%. You're borrowing 80% at 4%, yet you're making 8.25% on the whole value. That's where your spread comes.
Right.
So okay, that's good.
Yeah. So we started the negotiation process. Obviously, with any negotiating, you negotiate. We could do entire episodes on commercial real estate negotiating. I'm not going to dive too far into the weeds on that, but I would say, it's a process. It's a lot of give and take. You've got to be able to walk away. These big deals take a lot of time. We have, gotten in and gotten out of contract and gotten back in contract on deals, and then gotten out and gotten back in and then closed them. You can't be scared to put your foot down. At the end of the day, it's a big deal, and you need to be able to emotionally detach yourself and walk away from the deal, and know, what a good price and what good returns are. But
yeah, sometimes that's hard. We had another property here in Tulsa that was in a very good spot, and tried to negotiate and offered a really competitive price. And, it's almost like buying a house or something. Sometimes you get emotionally attached to these things just like you do your own home, and you got to be able to walk away.
I sometimes negotiate to a fault, which has resulted in a lot of the precision equity deals producing some really high returns, but it also has us buying less than I want to buy and buying less than my investors would like me to buy. But
yeah, so give the watchers or the listeners just a couple points on negotiating, how you can find things to get, discounts or credits to the closing, maybe after you already negotiate, or what your thought is. Maybe we're in contract on this now, but we're assuming everything they told me is true, and maybe it's not. Maybe the roof is older than they thought, so they're going to discount that. Or what are some of the things you're looking for when you're negotiating price?
Well, so there's probably a longer discussion to be had on negotiating, because it's pretty involved and complicated. But a couple of ways that I think you can get some success in negotiating is, I'll just kind of ramble off some off the top of my head. Properties that have been on the market for a while, for whatever reason or another. Now, you can say, well, it's been on the market, it's been picked over. Agree, but also the seller may be more reasonable to a lower offer than he would have been otherwise. So he didn't want to sell at a certain price. This happens all the time. And, I'm under contract in one in Bixby, Oklahoma right now, where the broker, they had it under contract, and they tried to get it a discount, and they would not sell it for less than than $2 million. And we come along after they fell out of contract. The guy had already been through all this long process, and I offered some non-refundable earnest money and was able to get a net purchase price of 1.9 that he just refused to the guy 2 months ago. So that's $100,000 in hopeful perceived value just by being the right timing. So that's a way that you can do it. Having leverage, like properties are struggling, they're going into foreclosure.
Maybe some vacancy.
Vacancy. And then, like you said, when you get it under contract, there are also then ways to get further discounts.
Yeah, so let's go through that. We've made the offer on the property through a letter of intent, and we'll go and dive deep on our letter of intent, and we'll maybe even give our copy or our version away. It's pretty simple. It's a Word document. A letter of intent is basically just a non-binding contract. It's super easy. It's a Word document with a dozen points that says, hey, here's roughly what I'm thinking, because these contracts, on these big properties can be cumbersome. There can be a lot of, little minutia and points that you have to negotiate on. So you put the most important dozen on there. How long you're going to take to inspect, how long you're going to take to close. Typically those are 30 days a piece, maybe 45, maybe 60, depending on the size of the deal. The purchase price, obviously. What else is going on the LOI?
Well, a lot of times, isn't the seller going to want some non-refundable money at some point?
Yeah, you need to talk about earnest money. So, you're putting up a deposit now that says, hey, here's $25,000 at the title company, like a residential deal. Most people have bought a house, that earnest money check you write. And then after your inspection period, that is typically non-refundable. So if you don't close on that deal, you walk away from that money, which can be a sizable sum. That can be a lot of money.
We'll agree. There's a lot we'll go over, maybe even specifically on that. But so you guys, let's go back to Redbud. You're under contract. Let's say you've done your due diligence. You've maybe done a property condition report. The bank has ordered the appraisal. I'll just ask you, how did you decide on the lender? Who loans on these types of deals?
Yeah, so we use local banks or credit unions for these type of retail shopping centers. They're typically super reasonable to work with, as opposed to like a CMBS company or a life insurance company, or bigger, more non-guaranteed debt, institutionalized debt. So we're working with local banks here in town, and
they like to just meet you. So we've, if you're trying to go someplace where the money's coming from out of town, maybe it's a little harder. But on these local banks, before we approach them, we try to find out who we might want to go to in the future, and we sit down and have coffee or lunch or dinner with them. And once they get to know you, then it seems like it's a pretty good relationship, and they're willing to work with you a lot of times.
Now we have to personally guarantee a local bank debt. Is that right?
Right, you have to personally guarantee it, which just means the bank not only gets the first real estate mortgage on the property, but they also get the right to sue you, and they will, if you foreclose on the debt or if you don't make the payments.
But they also, an advantage with the local banks, it seems like to me, is that if something does go wrong, they're willing to work with you. They don't really want to own that asset. Mm-hmm. They want you to succeed. They do their own due diligence on the property because they don't want to make a bad loan. And if something was to go wrong, then if you need some sort of special circumstances, then they're willing to work with you.
Yeah, and I would say on that point, banks are in the business of making money via interest on these loans, right? So they want them to work, and they want to place these loans. They get these loan officers, and these banks get paid to allocate this money in these deals. So, you're kind of the customer when you're buying a deal, in a sense, with the bank, depending on how competitive the banking market is that you're at. But a lot of the times, Joel, you might have 2-3 lenders bidding on a deal in the beginning. Obviously, you're going to try to weed that down to 1 or 2 at the end, and really just proceed with one after your inspection period.
So what is the typical terms that the investors or sponsors can get on a retail deal like this from a local bank?
Yeah, so there's a few things you need to pay attention to. It's who's guaranteeing the debt, and what that guarantee is for. Is it for all of it? Does it step down? Is there a prepayment on it? What is the interest rate on it? What is the amortization, or how long you're going to pay that back? And then what is the loan term? And then if the loan term is different than the amortization term, you need to make sure that you can make that balloon payment, because that's a big deal. If you have a 10-year loan and it's amortized for 25, you've got a massive balloon payment because you're not paying that off in 10 years. You're going to have to refinance it or sell it.
Yeah, so my experience on retail local bank lending is typically 20 to 25 years on amortization on a retail deal.
Right.
25, believe it or not, makes a big difference on your cash flow. So we've always tried to push banks to do 25, and usually there's a local bank that'll do a 25-year am.
Yeah, and it's cash flow, right? Because it's still kind of your own cash. You're just paying that extra down towards extra debt. So, I mean, it's theoretically kind of the same, but dollars today are always better than dollars tomorrow.
Yeah, and it's cash on cash percentage to the investors goes up with the longer amortization.
Right.
Rates have. Oh, go ahead, Brian.
Do the bank terms, are they ever different between retail and maybe multifamily, or do the banks consider, okay, we're going to either loan it or not, and they don't really care what the asset is for their terms?
As far as banks go, they're probably a little similar. We don't typically do fixed debt for multifamily with banks because Fannie Mae, Freddie Mac, and even CMBS have much better terms. But banks would vary some with apartments versus retail. But for retail, it's typically 20, 25-year am. They're usually fixing it for 3 to 5 years, although lately we've been getting banks to hit 10-year fixed.
God bless.
Yeah, and rates are really, really low right now. I've had rates on deals, believe it or not, back in the early 2000s that were up to 8-9%, but and that's of course terrible. But today, I mean, it's 3.75%, 4% on retail.
It sounds absolutely insane, but we literally just closed on a retail deal less than a month ago for less than 4% interest. Mm-hmm. I pay more on my house than we pay on that retail deal in the current state of retail too.
Yeah. Okay. So LTV, I would say, is 70 to 85%.
Yeah, on retail, on maybe bigger deals that are anchored by a grocer and they're getting life insurance company debt, they may go down to 60, 65. But I would say industry standard is definitely 70 to 80 is the sweet spot. But I've seen 65 to 85.
Yeah. Okay, so Redbud, you guys set up your debt, you did your due diligence, you closed on the property. Tell us what happens after you close. Who's managing it? How's it going?
Yeah, so we closed on the property in 60, 75 days. We had about a month of inspections that went pretty seamless. We hired those out to third parties. People are getting the survey, people are inspecting it. We're just reviewing that, sending it to the title company, sending it to our attorneys, yada, yada, yada. You're kind of just coordinating them at that point. You move into the closing phase, your lenders, gearing up a lot. They're getting ready for everything. And then, at the end of inspections, you really need to start thinking about who's managing that property. Like you said, we typically don't like to manage our retail. We like to go in and find, an institutional type management company, a big management company who manages a lot of properties like ours in that market. Mm-hmm. And then just interview them, see how they manage those other properties, drive by them, see how clean they are. But yeah, we hire a management company. They, on retail, they're typically charging, anywhere from 2.5%, 3 to 4% of revenue a month, which on a deal like Redbud is, I think less than $2,000 a month. And they manage everything. They collect the rent. They're
pay the bills.
They're paying the bills. They're sending late notices. They're filing evictions if you have them.
Doing all the bookkeeping.
All the bookkeeping. They're preparing the complete set of books for our accountant. So they export the complete set, send them to our accountant. But other than that, the month-over-month bookkeeping and reporting that we send to our investors is done by that management company.
So you guys just get, a monthly statement?
Yeah, we literally get a monthly report. They're due by the 15th of the following month. And who paid. I mean, you have access to the information. But yeah, we get a report and it says, hey, here's how much money you made. Here's all the tenants that paid. Here's the tenants who didn't. Here's the leases that are expiring soon. You may want to get in touch with them for a lease renewal. Here's any maintenance problems. The parking lot needs a reseal, or we budgeted this in September and it's a little over. So you're dealing with that. But the most time consuming part of this is when you're setting your annual budget year over year maybe, and even that's fairly easy because you've done that in the beginning. So, you set the budget, and 9 times out of 10, it stays inside the budget. All the preemptive maintenance or deferred maintenance, that's all going in a budget, and it's all on a calendar. It's not on a specific date. It's scheduled. It's through a management company.
So people might think, listening to this, well, it just can't be that easy. You can't just buy and then sit back and get a statement and money to pay your investors. But it really is. I've got a little example I'll throw in. There's a deal that we've bought that I put investors in 4 years ago, and I have to say, good or bad, I haven't ever been to the property. I've never even been there. I found it, I modeled it, I got the debt, I put the syndication together, and I've been paying distributions 12 to 13% to my investors every quarter for 4 years, and I've never been to the property. So,
Joel, I invested in one of your deals, and you've never been to the property?
Well, I think your partner went to the property. I mean, Joel personally, I don't know if has been to the property.
Yeah, I think they did. My business partner Victor went to the property, but and he went one time for one afternoon. The point is that it just doesn't. We have a management company managing that, and we just get a statement every month, and I just send checks to my investors every quarter. And for 4 years, that's been going on without a hiccup. So, not every deal is going to be that easy, but it absolutely can be that easy.
Yeah, and they're out there. There's a lot of those deals. There's a ton of those deals out there. Yeah. We're getting 100 of those or 100 of those deals emailed to us a week.
So that's a point that we can kind of try to wrap up on. Is Redbud's been successful? You're paying distributions to your investors, and we'll have pictures of it online and a video on the YouTube channel. But look at it. You'll recognize this deal. This deal is in your market anywhere in the United States. Yep. on a great corner in front of a Walmart, and anybody can buy that at an 8 cap, 8.5 cap. They can get good debt, and they can start either making money for themselves or making money for investors. Those deals exist everywhere.
Yeah, they're all over the place, and they're in all different asset classes too. I know we talked about retail today, but that was the focus. These same opportunities are in every asset class out there. But yeah, I mean the deal. I don't know that saying you guys say the
deal of the decade comes along once a week.
Yeah.
Yeah, I think old time guy Dolph DeRoos is where I got that. But yeah, it just encourages you to know that it's out there and it's available and it's not hiding. That's a center you drive by every day. But now next time you drive by it, you're going to say, I wonder if that deal could make me 17% return on my money. So hopefully this show is going to encourage you that it's possible.
Yeah, and how to do it. It's not that bad. In about 29, 30 minutes, you can go from how we found the deal to how we closed on it and what we're doing now. That's not bad. It's pretty easy. Brian, anything else?
I think we covered it pretty well.
Well, thanks for coming today, guys. I really appreciate your time. I think we're going to help a lot of people with this. I think it can kind of be overwhelming of where you're finding deals. What do you do? Oh, my gosh, there's all these things going on. But, I mean, really, it's not that bad. A few episodes of these, you're going to be able to run these deals no problem, or at least have the confidence to invest and partner with other people because you know the steps, you know the process. It's not that bad.
Yep.
Well, if you're watching us on YouTube, make sure to like and subscribe. If you're on Spotify or Google Podcasts or iTunes Podcasts, make sure to check us out on YouTube if you want to see the video version. But I think that wraps it up for episode 002. We'll be back in a couple days for episode 3. Thanks, guys.
All right. Thanks.